Okay, what this case asks you to visualize is an exciting scenario where after you graduate from this program, the Professional Accounting MBA program, you follow an unconventional track and you decide immediately to start your own independent consulting business in accounting information systems. And since you're just starting, you are the business, nobody else. You're doing everything in this consulting business. Just for starters, hopefully as the business grows, you will add more employees and divide the work. But right now, you are the only person working, but you have two customers, which are probably companies that that want to have your consulting services. We'll call them customer A and customer B, and you're contracted for two jobs for customer A, A1 and A2, and one job for customer B, job B1. Now, you're in the planning stage, and you're planning your costing system and your costing, and you need to do your costing as part of your planning for the forthcoming year. A, because you want to plan, you want to know how you're going to operate, but even for more compelling reasons, because the customers are likely to ask you, what are you going to charge us for the jobs? In other words, that's usually decided in advance. So you would have to price the jobs, to name prices for jobs, and in order to do that, you would want to estimate what the cost of delivering those jobs is going to be, to get some plans and some estimates, and on the basis of that, as one of the inputs, on the basis of which you decide what price you're going to charge. And as you agree on a price and you estimate your cost, you can also then estimate what the profitability of the various jobs is going to be. Hopefully they're going to be profitable. Sometimes when you start a business, you have to do some things that are not immediately profitable, but in any case you want to know to what degree they're profitable and what is the expected profits. So for that, you have to plan the costs, and that's what we're doing in this case. Now, in order to plan the costs, first of all, you have in Table 1, you get budgeted activity data, what you budget or you plan for the coming year. The duration is 12 months. And in order to plan your costs, you have to know what your planned activity is going to be. How active you're going to be in delivering the jobs. Remember, you're the only person working there. So you have the jobs in the columns here. And the lines, first line is W hours, hours worked. Then you have T hours, hours traveled. And then you have total, and you have the number of visits. Well, the story here is that in order to deliver the AIS consulting, you have to travel to, much of the time, you have to travel to customer premises. Much of the work needs to be done face-to-face with the customers and on customer facilities. So you have work hours, but you have travel hours, and you have the number of visits. So that's what is budgeted or planned in Activity Table 1. Any questions about Activity Table 1? Okay. Now, you have an office. You rent office space. You have expenses on electricity, systems, telecommunications, and equipment. You project them or budget them on a monthly basis. You add them up, and then you multiply by 12 to get them budgeted on a yearly basis as a total of $54,000 annual. And in order to visit your customers, you purchase a car, and the numbers here are the same numbers that we used in our car purchase for business purposes example last time. So you pay cash, $25,000. This is the accounting-oriented estimates, the economic-oriented estimates. Decide to use the economic-oriented. Well, you have to decide what you use, the accounting or the economic-oriented estimates. Now, what is important also for the case is that you decide not to pay yourself a salary for the work you do for the company, but what you decide to do to begin with is not pay yourself a salary, but just decide how much money you want to take for own use from the business on a flow-through basis. Hopefully, profits will start flow in, and you decide how much of it you want to retain in the business, how much you want to take for yourself, but officially, you're not paying yourself a salary. So that's number one. That's in the first sentence. You also know or estimate that outside your own business, if you want to do work outside your own business, you can be hired as a consultant by companies because you're good, you have good skills, and you have skills that are needed. So you can be hired by other companies at a compensation rate of $100 per hour for as many hours as you wish to work for. So now you have the case requirements here, and I'm not going to go through each one of them independently, but I'm going to leave it for several minutes here on the screen, and I just want to entertain your questions. Any questions about the case, and any questions about the requirements, clarifying questions, or any other questions that you have about the case requirements? Yes? No, the $100 per hour is not what you are paid for A1 or A2 or B1 because you're charging for them. So what you're paid for them is whatever you're going to charge, and that's one of the requirements. The $100 per hour is what you can get if you decide to take, if your hours of work are not filled by your business and you decide to do additional work outside your business and you're hired, that's where you get the $100 per hour. Yes? That's for you to decide. It's an interesting thought. Yes? Right. Well, the first question is, the story assumes that you use for the cost driver that you use to allocate your costs to the different jobs, you use the total of hours worked and hours traveled. But then the question is, That's what you decided to do. But then the question is, why is it preferable to use this as a cost driver to allocate costs rather than using the number of job visits as an alternative cost driver? Why is it preferable? Do you have reasons? In other words, you chose to use the total number of hours, right? But you could have, if you wanted to, use the number of visits. The number of visits that you paid for the customer as a cost driver. And the question is, why do you think it's preferable to use total hours rather than number of visits? Okay? Why do you think it's preferable? If you think that it's not preferable, you could say so. You can explain why you think the number of visits are better cost driver to use. Okay, any other questions about the questions or anything to clarify? Okay, before we move to our own material and we leave this case, I just wanted to be sure that all the groups are organized. You belong to a group. You're acquainted with the group you belong to. You're connected to your partners. Great. And the other thing to remember is, I'm sure you did it already, is to designate a person in the group who will be responsible to submit the written report no later than the due date, and to submit it into 3 addresses. To submit it directly via Blackboard to me as you submit the assignments, and also to submit directly as an attachment via regular email a copy to our TA Girong and a copy to me. Of course, don't forget, that goes without saying, but sometimes pressure is intense and people forget the number of the case and all the members, the names of all the members of the group should be on the case when it's submitted. Okay, now before we move on, any questions that you have about assignments? You have assignment 1, which is due on Monday, same time, no later than Monday, 10 p.m. Any questions about the assignments, or everything is clear? Yes? Yeah, you can always email to me. And what I would answer is, I would clarify. Of course, I'll be very careful not to give you any clues as to the answers. So what I will do very willingly, anytime you have a question, is clarify the questions or the requirements any way you wish. Okay? So if anything comes up, you can always shoot an email. Okay? Okay, let's get back to our lecture. Okay, since management accounting is dealing with the bulk of the information system that is available in firms to support decision making by managers, it's important that we get some common understanding as to what those firms or companies or business enterprises do. Of course, it's a big question, but let me try to propose some useful ways to look at it and see. Of course, you can have different ways of looking at it, and I'll be happy to hear from you. But basically, what I'd like to propose is the following thoughts. First of all, the straightforward thought that business enterprises, whether they're corporations or partnerships or so forth, are there to create value. There's no other reason for them to be there if they don't create value. Actually, if you think about it, if business enterprises don't create value, they're not viable. They're not going to be there for long. They're going to go under. So business enterprises are there to create value. And how do they create value? They create value through the production and sale of goods and services to their customers. And they do that so that they can serve, the firms do that, the managements of the firms do that, deliver great value by delivering goods and services, so that they can serve their constituencies. So in a moment we'll discuss who are the major constituencies or stakeholders of business enterprises. Actually, let's get to this right now. So in the table here, you have the categories of the major constituencies of business enterprises, or the major stakeholders. And I hope I didn't miss an important category, but if I did, I rely on you to mention it and edit. But so let's go over the constituencies. First of all, we have the owners. The owners of the business enterprise are a major constituencies. And the owners, if the business enterprise is a corporation, obviously the owners are the shareholders. And for example, if it's a partnership, then the owners are the partners. And what are the objectives of owners? Well, the overriding objective of owners is to increase their wealth, to augment wealth augmentation, to augment or increase their wealth by becoming owners of the enterprise. So, for example, if you go out there and buy 100 shares of Google, you become an owner of Google, albeit small, but you are an owner of Google by being a shareholder. And why do you do that? The overriding objective is that you think it's a good way to increase your wealth by hopefully increasing the value of the shares that you buy. So that's the overriding objective. And of course, the performance of the business for you is determined by whether they are able to grow the value of your shares, to grow your wealth, and by how much. Another major constituency is the customers. Remember, the value that you create are for your customers. And what are the objective of the customers? Well, we are all customers, so we know what is our objective when we are customers of products or services. What is our objective? Our objective is to be satisfied by the products or the services that we buy. So it's customer satisfaction. What is the performance that is required? Could be a good quality price ratio, good customer support, and many other features. Can't mention everything here. So obviously the customers are extremely important. Any business enterprise that doesn't satisfy its customers for a long period of time will go under. There's no way that you can exist in a competitive business for a length of time without finding a way to satisfy your customers. Employees, very important constituency, because remember, it's true to say that in most business enterprises, the biggest asset that you have are your human resources or your employees. And in order to succeed in delivering your objectives, you have to meet the objectives of the employees. And what are the major objectives of the employees? It has to be fair and adequate compensation. Other features could be security, personal growth, morale, various working conditions have to meet the objectives of the employees. If they don't, you're going to lose your best employees, because your best employees can, by being the best, are likely to find employment elsewhere. Okay, then most enterprises function through leverage, through raising funds by borrowing, and therefore creditors, once they borrow, creditors become a constituency, and creditors' objectives have to have a reliable debt service and manage risk well. Most companies buy from other companies inputs, and therefore, and those companies from whom they buy their inputs that are necessary for production of goods or services are their suppliers. So you need a network of high quality and reliable suppliers. And what do suppliers want from the companies? They want the companies they supply to be profitable, steady, and reliable customers. So that they want you to be reliable customers so that they can thrive. Finally, you have the community, or the communities that the business enterprise operates in. So we cannot assume or take for granted that communities will always be hospitable and allow the companies that operate them to operate at all or to operate with ease. In order to earn the cooperation of the communities that you operate in, be it local communities, cities, states, countries, you need to be perceived as a good citizen of those communities. If you're not a good citizen of those communities, they may restrict you, they may increase your regulation, and therefore, good citizenship, and there are many variables to this good citizenship in terms of civic involvement, in terms of helping sustain those communities, not harm them in any way. such as harm the environment by your operations, as one example, are important. So basically, if you're managers of companies or business enterprises, you have a difficult task on your hand, because you have your task is to satisfy, to meet the objectives in a reasonable way, to meet the objectives of those constituencies. And different constituencies have different objectives, and sometimes the objectives don't coalesce. And in times the objective may contradict each other. And you as managers have to find, you'd have to find a delicate balance and a fine line in terms of meeting those objectives, because if you fall far short in meeting the objectives of any of those constituencies, it's easy to get yourself into trouble. So we could say, therefore, that the effectiveness of managers can be measured by how well they meet the objectives of their constituencies. So that's one definition of effectiveness, how well you meet objectives. For example, if the objectives of your owner is growth in the wealth of the company, how well you're doing, or growth in the profitability of the company, how well you're doing there is one measure of your effectiveness. Now, in this context, I just want to remind you, and we'll discuss it further in this course in greater detail, but I want to remind you that we do differentiate between effectiveness and efficiency. In ordinary language, they're sometimes used interchangeably, but we would like to really differentiate between the two. Effectiveness is defined by how well you meet objectives. Efficiency is defined by how well you use inputs to produce outputs. If you use inputs non-wastefully, and therefore at low cost to produce outputs, you're more efficient than if you don't do that, if you waste inputs and you increase your costs. So that's how efficiency is measured. Now, what is important to remember that sometimes efficiency, at times not sometimes, many times, efficiency reinforces effectiveness, but not always. In other words, there could be situations where you could increase your efficiency and be ineffective. To give you a simple example, to give you a simple proposition, then we'll go through examples. To give you a simple proposition in business, you can become increasingly more efficient in producing a product or a service in the sense that you use less inputs to produce the output, and you figure ways to be less and less wasteful and more use less inputs to produce a unit of output and save costs, reduce your costs in producing units of certain products or services, and that will make you more efficient. But if the products or the services that you produce this way are products or services that are not wanted by the customer, then you will become ineffective. So you can become increasingly more efficient, but if customers don't buy your product, for example, your profitability may decline or disappear. So that's very important to understand. You want to be more efficient, but not for the sake of being more efficient. You want to be more efficient only for the sake, only if by being more efficient you can be more effective. So the proverbial example is you can increase your efficiency and save costs continuously in producing mouse traps. But if mouse traps are not wanted by most customers because there are less and less mice in households, then the fact that you become more efficient doesn't lead you anywhere, because if mousetraps are not wanted because they're not needed, you won't sell, and you want to achieve your objectives relative to your constituencies. So that's important to remember, the difference between efficiency and effectiveness, and that you want to be more efficient only if it's important. And we'll talk a lot about efficiency and productivity. You want to be more efficient, but only under the circumstances where by increasing efficiency you can also increase effectiveness. Okay, any questions about constituencies, the degree of effectiveness? Now, why is it important for us to have this conceptual framework? Because remember, as professionals, we may either eventually be in managerial positions where we have to worry about meeting how best we meet the objectives of constituencies, or we may be cost managers or accounting professionals. We may be in corporate accounting, and we may be managing costs or recording costs or classifying costs or assembling and interpreting costs to help managers make the right decisions. So we have to know what motivates managers, because managers are our customers if we are in corporate accounting. If we're not managers ourselves, if we prepare and analyze the information for them to facilitate their decision making, then they're the customers, and we have to understand our customers. Why do they want the information that we provide them with, what they're going to do with it, how they're going to make decisions, what's going to motivate. Furthermore, even if we are not in corporate accounting, even when and as long as we are in public accounting, remember, we audit companies. So we audit the performance of managers. That's what we do. And in auditing the performance of managers as external auditors, we continuously get from them information, interact with them, and we have to understand how they function and what their objective is. And because of all of that, this type of conceptual framework is important to us as professional accountants, in whatever career path we are in accounting. Okay, here's a list of partial list of what managers in turn need or would want from their constituencies in return for meeting their objectives. So from owners and investors, managers would like owners and investors to trust their competence and their integrity. They would like their customers to be satisfied, and by being satisfied, to be loyal to their products and services and brands, and to be responsive constructively. That is, you like your customers to be responsive. You like feedback from your customers because That gives you information on how well you're doing. But obviously, ideally, you like constructive feedback. That's the ideal situation where the feedback that you get is meaningful and can make you respond in terms of improving your service or your product. You don't like frivolous input. You'd like to avoid. Now, from employees, from your own employees, in return to meeting their objectives, you would like competence, loyalty, commitment, motivation. And other things that's self-explanatory. From suppliers, you'd like good cost-quality ratios, reliable supply chain, and so forth. And from the communities that you operate in return to being a very good citizen in those communities, you would like them to supply you with what you need in terms of law, order, good infrastructure, good education, because you need educated employees, and you need the employees to be happy to live in communities which supply good education to their families. So education, health, generally favorable business climate. Okay, any comments so far? Things that we might have missed that you think are important? Be very welcome. Okay, let's talk now about a very important concept, and that's the concept of the value chain, because that goes to the core of value and cost, which we are going to be dealing a lot with in this course. So we have the following propositions here. Let me see if you agree with those. We agreed that companies, business enterprises, are there to create value. But now let's have a chain of very obvious propositions, but that sometimes are forgotten nevertheless. Bless you. In order to create value, we need to engage in activities, right? If we are inactive, we are not going to create any value. Difficult for me to perceive how anybody can create value by being completely inactive. So in order to create value in business anywhere and in business enterprises, we have to be active. Those business enterprises, the people who work there have to be active. But in order to be active, we require resources. We may require labor services, we may require materials, we may require machinery, equipment, and so forth. We may require knowledge, technology. But even if we just operate the way we have in case one, you're becoming an entrepreneur, and you're on your own and you provide consulting services, you need knowledge for that. You need education. So you need your own, you engage in mental activities of your own, which are your resource. And that requires the input of time. So your own time becomes an important resource here. So however you put it, there's no way that we can engage in activities without the use of resources. But once we use resources, and most resources are scarce, the way we discussed it in our last meeting, most resources are scarce. So the use of these resources involves costs. It's very difficult to use resources without incurring costs. So here we get to the costs. Now the combination of the activities the resources and the cost incurred, all in combination, create value by producing goods and services. So we produce goods and services in business enterprises by combining activities, resources, and incurring those costs. So that's where we produce value by we produce goods and services, and those goods and services produce value to the customers. So it's important to keep in mind this chain, which is very often called the value chain. How do we create value? We start with activities. Can create value without being active. We have to deploy resources. The resources are costly. Combination of all of this is used to produce goods and services that produce value. So obviously it looks straightforward, but we don't always think about it this way. But it's very useful that in management accounting we remember this value chain. Now, obviously what we are saying is that we have to produce, we have to create value. We create value by activities. So in going through this, so one of the things that we do, which is important to do as business, is to do activity analysis. To look carefully at all the sequence of activities that we have to perform in order to create value by producing goods and services. Now, once we study and sequence those activities, it's important to decide which activities add more value and which activities add less value. Of course, obviously, if you can, you want to minimize the activities that add less value, and you want to maximize the activities that add more value. For example, activities that are direct productive or processing or operational activities usually produce more value than indirect or auxiliary activities that may be less value producing. I'll give you an example of an activity that is indirect. Accumulating inventories at various stages of production, inventories of raw materials, inventories of intermediate goods, inventories of finished goods. Why do we do that? Because presumably we need those inventories as buffers. Very often we need materials, and the materials are not immediately available because the supply chain of the materials is inefficient. So it's good to have materials in inventory so we don't slow up or have to interrupt our production process. Same thing goes for every intermediate stage in production. And sometimes if there are disruptions in production, we don't get enough finished goods on hand, and we have a backlog of orders. So we have to keep inventories. So we do keep inventories for a reason, but inventory is not a directly productive activity in terms of adding value. It just facilitates adding value. So when we analyze that and we realize that, so one way to increase our efficiency and effectiveness in productions or in operation, for say in manufacturing, one way to increase our effectiveness is try to streamline our supply chain and our production so that things get done in time and we minimize the inventories that we need on hand. Now, by minimizing the inventories that we need, we save on an activity that doesn't necessarily add much to value, and we save on costs because keeping large inventories, warehousing them and keeping them is a costly proposition. So there's a movement that developed which was called just-in-time movement, where you try to keep inventories close to zero, and you're able to do that without suffering by having every stage of production finished just in time for the next stage. So you increase the quality of your production so that you need less inventories. So you save on an activity that has less value added. So what generally you want to do in the value chain is analyze the activities, estimate and assess the value added of each activity to the goods and services, to the creation of value, and compare it with the cost, and try to minimize, if you can, those, or reduce or eliminate those activities that produce low value at high cost, and concentrate on the activities that produce high value at lower cost. Okay, if we stay with the value chain, value is developed chronologically in operations or in production through a sequence of chronological activities that could be usefully represented in this scheme, where you could visualize that in developing and producing a product or developing and rendering a service, you start with research and development, researching and developing the product and the service. Then you go to the design stage of designing them. Once the product is researched, developed, and designed, you produce it. So there's a production stage. Then once you have the product, it's very important to know how to market it. So you have the marketing stage. And then distribution is important, how you distribute it. And once you distribute to the customers, depending on the product, you may figure out how you do customer support, how you deliver customer support services in terms of supporting the customers whenever needed in the use of this product or this service. Now, of course, what is important to remember is that these are stages in the creation of value. There are some companies that are fully integrated vertically, which means that they do all the stages. They start with research and developing a product or a service, and they go all the way to marketing, distribution, production, marketing, distribution, and customer support service. But those companies are in the minority. Most companies are organized so that they do certain stages, and then they leave it to other companies to do, they sell to other companies intermediate products to go through the other stages. And the reason for that is that with production becoming so complex, companies need to specialize in the various stages, and companies, in many cases, companies find it easier to become big specialists, say, in marketing and distribution, and leave it to another company to specialize in design and production. So the companies specialize in design and production then sell what they produce to companies who do the marketing and the distribution. So it's a question of specializing. And the idea is, as much as we would want to, we cannot do everything along the value chain as well as others can. So if we can't, We'd rather concentrate on what we can do best and let others do what they can do best. A striking example of how this thing is taken to what we consider right now, maybe future we won't, right now we consider it as unusual or extreme. Some of you may have spotted in the op-ed page of the New York Times an article by Thomas Friedman yesterday on the changing technology in education. Well, he talked generally about changing technology in education, about the availability of the internet, all the communication services, and about all these large courses that are taught on the internet that all of you heard of. But large courses that are offered on the internet, not for credit and for credit, and they talked about that as a future, as one of the future paths in education. But what caught my eye is, in the context of what we are discussing of doing things best, is that he tells the story. He was at a conference organized by Harvard and MIT, and one of the presenters was a Harvard professor at the business school, and he told the conference that recently in the Harvard Business School they decided to discontinue teaching the entry course in accounting. Well, sounds strange, right? Why would they discontinue the entry course, teaching the entry course in accounting, which is, of course, one of the required courses? And they said that the reason was that they analyzed availability of courses, and they found out, to their surprise, that there is a professor in Brigham Young University who teaches an entry course in accounting better than any of their faculty could ever hope to teach it. They just admitted that, which is not a small thing, because if you know faculty of those top schools, such as Harvard, they have big egos. So for them to admit that there's somebody in another university not that well known who can teach the course so well that they can never hope to match it is a big admission. But anyway, they analyzed it and they admitted it, and they said, well, if that's the case, we're going to have our students take this course. Now, they didn't bring the Brigham Young guy to Harvard. Maybe he doesn't want to go to Harvard. Maybe he is happy in Salt Lake City. Whatever but what the technology enables them to do is to make the course available on the internet, of course, with the agreement of Brigham Young, or even to get the course and beam it internally to the computers at Harvard, and then to supplement the course, supplement what the other guy teaches with sessions where they discuss certain aspects of it, answer questions, do tutorials, and so on and so forth. But the key is, they said, look, if somebody can do it better, we'll get it from them. So that even becomes the trend in education now, let alone that has been ongoing practice in more conventional, traditional business. Okay, let's do some talk about business concepts. Many of those concepts we have already discussed previously. The one thing that I want to alert you that we will be talking a lot in this course about a weak link in accounting, and that's intangible assets. Intangible assets in economy that is based on knowledge, on development of knowledge and technology, intangible assets are becoming, in many companies, a much larger share of their assets. So it's very important to know how to measure them and to account for them. Now, accounting is very leery of that because, again, as we talked about it before, when we talked about opportunity cost, it's very difficult often to estimate, to describe what these intangible assets are, such as knowledge and technology and skills, and to estimate them. But the reason, so accounting wants to stay away from it, except with some exceptions, some weak exceptions in terms of accounting for goodwill, but goodwill really doesn't account for intangible assets well. So accounting wants to stay away from it, but that doesn't mean that we can get rid of the problem. The problem is that there are many more and more companies where the bulk of the assets of those companies are intangible assets. If you look at a company like Apple or Google, and you look at the balance sheet and you total the value of their tangible assets, you know, they have buildings and they have equipment and they have systems and so on, and all those are tangibles. You get a value, but the value of their assets, for example, is a fraction of their value in the stock market. And why? Because the majority of the assets that the value of their stock, their capitalization takes into account, rightfully so, are intangible assets, which are not well accounted for. So we're going to talk quite a bit about intangible assets in this course. The other thing that we didn't cover in terms of concepts, many of those concepts we did cover. Important, you have to be careful when we do manage costs and do management accounting analysis to be careful to distinguish which costs are relevant. Because remember, we're often assembling costs and presenting costs and analyzing costs for a purpose. And one of the major purposes is decision support. We analyze, we measure, collect, measure, and analyze costs that will help managers make decisions. So for example, if we do that, it's important to distinguish and determine which costs are relevant for the particular decision that we want to support and which costs are irrelevant, because including costs that are irrelevant or omitting costs that are relevant may lead to the wrong decision. Now, we already discussed the problem of omitting costs that are relevant to a decision when we discussed opportunity costs. We said these costs may be very relevant to certain decisions, and if we omit them, it may lead to wrong decisions. Let's talk about costs. Let's talk about costs that are not relevant, but that we may be tempted to include them in making a decision. Let me give you a pertinent example. Let's just continue with, remember, we discussed the cost-benefit analysis that you could do, the cost-benefit of investing in the MBA Professional Accounting program. Well, let's amplify this example a little bit, and let's add to the story, and let's say that tomorrow somebody materializes in your life a long-lost uncle or a long-lost aunt or a long-lost childhood friend, and they give you a proposition, a business proposition, that they claim is so good that you, as a business proposition, you cannot refuse. And what they say is, we're starting up a company. If you come and work for us, the company succeeds. You succeed beyond your wildest dreams. Of course, there's big risk in startups. A company may fall and you fall on your face. But of course, they like to look at the bright side. And they say, okay, we want you to be one of the, with us at the founding of the company, and you want to work for us, and you're going to get equity and whatever the story goes. But you have to start tomorrow or the day after tomorrow, because we don't have time. Company has to be on and going, so we can't wait for you to graduate in August. So if you want to avail yourself of this opportunity, you have to quit the program. Well, then you have to do a cost-benefit analysis. Some of the costs that you have taken into account, what are the costs of quitting the program? Now, emotionally, people tend to think in the following way. All of us, I'm not, are tempted to think emotionally. I've already invested so much in the program. Tuition, opportunity cost, what have you, for 3 semesters. You're in the 3rd semester. I can't quit now with all the costs that I already invested. Or I have to take them into account if I make the decision. But the question is, are they relevant for the decision that you're going to make, whether you continue with the program or you quit and join and pursue the other opportunity? Are the costs that you incurred already in this program relevant for this decision? What do you think? Sunk costs. Yeah, you say, and if there's sunk costs, what does it mean? Relevant or not relevant? Irrelevant. Yeah, so basically, the uses of sunk costs, I would like to emphasize, I'm not particularly enamored with the word sunk. I would rather use the word irretrievable. That cost that you cannot retrieve. The reason they're often referred to as sunk costs is because the idea is that something is sunk, you cannot retrieve it. But today we can retrieve sunk ships and recover treasures for them. So it doesn't follow that what is sunk is irretrievable. So let's use the word irretrievable, but that's essentially what you mean. So if the costs are irretrievable and the costs of what you already incurred in the program are irretrievable, then they're irrelevant. What is irrelevant is what are the different costs and benefits in the future of doing one thing, of taking one alternative or another. So it's important to realize that these costs are irretrievable. It's the same like as you got a hot tip from a friend. Now that the stock market is doing so well, you got a hot tip about a stock. You go and buy the stock at 40. Your friend predicts it's going to go to 80. It goes to 10 in 2 or 3 months. It goes from 40 to 10, you lose $30 on each share you bought. Now the question is, do I hold to the stock or do I sell it and do something else with whatever money is left? So again, the emotional thing is to say, I can't sell it now. I lost $30 on each share. I have to wait until I can at least recover. But of course, again, the $30 cost on each share is irretrievable. Well, you may retrieve a small part of it if the tax laws, if you can offset your losses against gains, and you may save some taxes. But let's forget about the taxes for a moment. Otherwise, it's irretrievable, so it's irrelevant. What is relevant is if you hold to the stock, continue holding to the stock, is it going to rebound in the future? Is it going to do better? If it goes to rebound and very well and do better than other things, so you should hold to it. And if it's going to languish, then you should get rid of it without paying attention to those irretrievable costs. The problem with such irretrievable costs is that emotionally it's very difficult because it hurts to incur losses. And emotionally, psychologically, you say, I incurred a loss, I don't want to admit to it. I want to deny it, and I want to hope that I can somehow recover from this. So we're going to talk a lot about which costs are relevant and which costs are not. Finally, I don't think that we talked yet about, we didn't talk about variable versus fixed, right? But you must know variable versus fixed. Have you covered variable versus fixed in your managerial economics course? Think so, right? So remember, variable costs are costs that vary with the cost object, and fixed costs are costs that don't vary with the cost object. So if your cost object is the quantity of the product, so in that case, fixed costs are costs that don't vary if you produce more or less of the product, and variable costs are costs that are varying. Now, just to remind you, why are there fixed costs at all? Why can't we vary costs if we suddenly are notified that in the next months we have to increase our production by 40%? Why do we have fixed costs? Well, because we have to distinguish between the short run and the long run. A short run is a period where we cannot adjust all our resources to the new changes. So for example, if next month we need to produce, because there's increased demand, we need to produce 40% more than we produced last month, what can we do within a month? We can probably find more materials. So the cost of those additional materials is a variable cost. We can vary it. We can probably engage more labor services, either hire additional people, maybe not, maybe a month is too short a time, or ask our people to work overtime, so increase the hours worked. But it's unlikely that in a month we can expand our plant, buildings and land and so on. It takes longer time to do that. So for a month, if the period is a month, that may be short run to vary certain inputs, and therefore the cost of those inputs remain fixed. You contrast it to what is known as the long run, and the long run is defined as you're given enough time that you could change or adjust all your resources. For example, you are told that you have to plan for the fact that production will increase 40% in a year. Well, in a year, you may be able to adjust everything. You may be able to adjust your plant, your equipment, may be able to adjust everything, in addition to your labor and materials and machinery and so on. If you're able to adjust everything, then all the costs are variable. So that's why we say in the long run, all costs become variable costs, but in the short run, because certain resources cannot be adjusted, the costs of those resources are fixed costs. Now, why is it important? Again, I told you that in management accounting we don't bother with concepts that don't have immediate importance. Why it's important? Because differentiating between variable cost and fixed costs can be very important for certain decisions. Give you an example. You operate an airline. We're going to have an airline case later in this course. But you're operating an airline. A flight is scheduled. It cannot be canceled. The flight is scheduled because it then has to be routed to go to one airport, and then it has to be routed to another flight. So the flight is scheduled, it's going. Once the flight is scheduled, a particular flight, what are the costs that vary within this context if you put more passengers on this flight? Or what are the costs that are fixed? Let's put it this way. If the flight is not full and you can allow more passengers on the flight, which costs are fixed? The cost of operating the aircraft are fixed, right? The cost of the fuel, more or less fixed. Maybe some very heavy customers will add a little bit to the consumption of fuel, but other than that, the costs are largely fixed, right? The costs of the crew, mostly fixed. I mean, you need the same number of pilots and navigators, right, to fly the airplane. If you add maybe a large number, the flight is really almost empty, and you add 40, 50, 60 passengers, maybe you need another steward, a stewardess. But largely the costs of the crew are fixed. Say you want to add 5 passengers. So these costs are fixed because within the time frame that you have to fly this flight, you cannot adjust those resources by the nature of the situation. So what is variable? It's very difficult to think about what is variable. Food, whatever food is served. Less and less food is served on airlines today, and the value of it is dubious. But whatever it costs the airline to provide the passengers with some food, if it's not an airline that asks the passengers to buy the food, so maybe the increment cost, maybe what is variable with additional customers is the food. What else? No, airfares is a revenue, it's not a cost. Airfare is what you're going to get from adding customers. Yes? I'm sorry? Yeah, so, well, in any case, I think the point is made that the variable cost is minimal, right? So, obviously, pricing decisions, those added customers, you can, if you charge them even very little, right? As long as you more than cover the variable costs, you can make additional profit, right? So that's an important decision to be made. Now, how do you do that is a different situation, because you don't want to announce that in advance, because otherwise you would lose customers that will pay the full fare, right? So you have to find a way of doing that. There were ways of doing that. For example, if you remember, the practice has been largely discontinued, but there was, if you remember, there was a practice of standby. And the idea for standby is you go there. So these are for customers who don't need to be assured that they fly on a particular time. You just go there, and if there is, and you're in a standby, and if there is room left, you go on the airline for a much lower price. It's one type of situation. But just an example where in pricing decision, it's very important to distinguish between which costs are variable and which costs are fixed if you want to make decisions that will increase your profits. So we're going to discuss quite a bit about this. But it's important to remember that there is a difference between between variable and fixed costs and direct and indirect costs. They're not the same animal. It's a different categorization of costs with different uses. Okay, let me just leave you with anything else that we need to do to amplify or clarify the discussions on this, on cost concepts. Any questions? Okay, now, yes. Yes, of course. Well, that's for you to decide. That's one of the questions in the case, right? Well, remember, you have to make, in this case, you have to make business decisions, right? What you're asked to do in this case is to cost your jobs, to estimate what would it cost you to provide jobs A1 and A2 and B1 to the customers, right? So presumably, as a decision maker, you're the manager of the company. Actually, you are the company. You're the CEO too. And what your objective is to come with the best business estimate of what your cost is. Because you want to have the best estimate because you want to price on this basis. And you want to assess the profitability of your customers on the basis of the estimate cost. So the question goes back to you, which one of the cost estimations, the accounting-oriented or the economic-oriented, serves this purpose best? And that's up for your group to discuss and answer.